Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. Great to have you here today for this podcast, for this radio show. We got so many good things to cover. It's kind of hard to choose what to pull off from the newsletter on topics because there's so many good things that happened this past week, so many things to talk about. What we're going to talk about today, the three top topics, was U.S. tariffs. Well, they're hurting China. We know there's been a deal with China, expected 90 days, but their economy is hurting quite a bit, and we'll talk about that. Also, to inflation, well, it continues to cool. We had some good news there. We'll talk about inflation, how it is cooling, give you some numbers that you can back up when you talk to people saying, yeah, inflation's not that bad. And then also, too, I know a lot of people are concerned about AI, artificial intelligence, just going to replace all humans. So I'm happy to report we're going to talk about that. Could it actually create more jobs? So some things that people may not be ready for. And if we have time, maybe we'll talk about oil.
Yeah, I mean, we'll see. And as always, too, we're going to talk about companies here. And there's some big announcements in terms of mergers and acquisition this week. We're actually going to take a look at two of the big ones. Dick's Sporting Goods, we're going to look at them. We're also going to look at Charter Communications. And then we also want to take a look here at the company Krispy Kreme. Some interesting information there. And lastly, Lyft. So we're going to break down the fundamentals, give you our opinion if we think it's buy, sell, or hold based off the numbers we see for those four companies.
All right. Well, let's dive into the U.S. tariffs are hurting China. Now, I know we've talked about this, Chase, on the show. We've talked about it on our newsletter many times that China has had trouble for years with their real estate and everything else. But exports from China, they dropped dramatically, which has weighed on their economy even more than before. This has caused, and I didn't think this would happen, but it did cause protests. I didn't think you could protest in China, but they did. Lost jobs and lower wages in the economy. So they had a lot of pressure. And I got to be frank, I don't think we've seen much pressure here from the tariffs.
I disagree with that.
What have you seen? I mean, the only thing
kidding me? I see people driving home holding picket signs like, oh my gosh. I would say we've definitely seen pushback on the tariffs from our people.
That is kind of like the consumer confidence. Oh, things are terrible, but then they go to the movies. No,
you've seen the protests at Tesla where people are standing outside. We have definitely seen pushback. Yeah, that is crazy.
Okay, I guess on that respect, I was talking about on the dollar, like your actual spending, because the only thing I've seen so far, we buy our fancy pens here, and they charge us, a $70 tariff charge. But that's the only thing I have seen. I've not heard anybody tell me like, oh my gosh, I bought this and the tariffs hurt me. I've not heard that. And I maybe I don't talk to the right people, but you're right. I've seen protests. I've seen people complaining, picketing. But again, I think they just think it's going to be bad. But I don't think it's bad yet as far as our pockets go.
Yeah, I mean, I would agree that I think and we've talked about this a lot, their actions aren't matching what they're saying. I mean, the big one we're not going to get to today, so I'm going to give this number anyways, is the retail sales. We saw a 7.8% increase in food services and drinking places, so restaurants again.
Yeah.
And if you're protesting, picketing how hard tariffs are, that is just crazy that you're spending 7.8% more at restaurants. That is the first thing that would go if you can't afford to live, essentially.
Well, Chase, what happens? They're out there picketing. You're doing this for 2-3 hours.
Hungry.
I'm hungry on Thursday. All right, I got to go eat now.
But I would agree with the fact that obviously these tariffs have been talked about, but it seems like people haven't really acted upon them just yet. And they were very brief, I would say. It's been about a month, essentially, a little bit over a month. April 2nd was the big day the announcement happened. But the big reason that we see this here is we, again, don't have an export-driven economy. So we're not going to necessarily lose jobs to the same magnitude China would, because if people with tariffs on our goods, we don't really export as much as China. And the number here that just was mind-boggling to me was exports from China to the United States dropped 20% in April. I mean, I guess it makes sense because of the big tariffs, but that is detrimental to their economy. In China, they did pick up exports from other countries like Indonesia, Thailand, and Africa, but I just got to say, I mean, those countries, they pale in comparison to the U.S. consumer. We are a consumption-based economy, and other countries want to sell to our U.S. consumers because we're huge. We love to spend money, and it's a great market to be in.
And we got the money to spend. And it was amazing, too, that China's economy does depend on exporting. About 1/3 of their GDP in 2024 came from exports. That's a huge thing that they have. And, yeah, they can replace some of it. But our GDP is, what is our GDP now?
20 trillion.
I think
21,
like
22 trillion. I haven't looked at it in years,
I guess. It was like 29 trillion. But I mean, I want to say that's probably bigger than many of the, when you talked about Thailand and Indonesia, Africa, it's probably 3-4 times what the combined of those are. So again, we do a lot of spending, and China, it really hurt them go to bed.
This is the AI overview on Google, so I'm pretty confident in that number, but just in case you're like, that number is wrong, it's like, well, that's what Google told me. It is 29.35 trillion, so yeah, almost $30 trillion. Yeah, I mean, gosh, I was way off on that.
Yeah, you're still back 3-4 years ago. Come on, come up to 2025 here.
Time flies. But, China, they're interesting as well because they'll sit there and tell you there's no problem, right? They want to provide that strength and tell their citizens that everything's good, and U.S., they're the ones that are hurting. But their actions definitely seem to be kind of counter to that fact. The government definitely appeared to be panicking a little bit. The central bank in China said they would cut interest rates and inject more liquidity into the financial system. I don't think if everything was okay in China, they would be acting that way.
Correct.
So, I mean, they definitely seem to be seeing a little bit of pain there. And also, too, some factories in China, well, they were pausing production, laying off workers until things pick back up. Again, if you don't have the orders coming in from the United States, you're just going to make more product. And the funny thing is here, China has done this in the past where they built their ghost cities.
That's right.
They almost dumped money in. And I think maybe they've learned the lesson. Maybe they're like, well, actually, we need the demand first before we just spend money.
And again, remember, they are a communist country, so they made a mistake with the real estate. You just said maybe they learned, like, oh, in capitalism, you can't just build it because it may not be bought.
So, what's the Field of Dreams? If you build it, they will come.
Doesn't work.
Didn't
for
show
China.
up. Yeah.
I like this too. Goldman Sachs estimated that roughly 16 million jobs in China come from exports just to the United States. I mean, that's huge. I mean, I don't know how many people they employ. I know they're a huge country, huge population, but I don't care how big you are. 16 million jobs that are affected by the United States. That's a big number to play with.
You got 16 million people that are going to be upset.
Yeah.
They don't have a job.
And then they'll stop spending, like, oh, I'm not going to do that. And then that'll hurt the local grocery stores, everything. It's going to really hurt the economy. So that's why I think they came to the table.
Yeah, I mean, it was good to see it. And frankly, I'm going to say shocked. I did not think we were going to get that. And we haven't gotten a broad trade agreement. So don't think like, wow, we got this great thing going. I mean, what has happened is the U.S. is now going to have a 30% tariff on many of the Chinese products. And I thought this was interesting. 10% is essentially related to trade. They still have 20% on due to the fentanyl crisis. So, I mean, that is kind of interesting to me that is still carrying a higher weight than the trade disagreement. But, I know that's a big sticking point to the Trump administration. So,
and to me, and I'm not a drug expert, but to me, that would seem a very easy, fixable problem on the fentanyl trade. But maybe I'm wrong. I could be missing something.
I don't know how it all kind of filters through. I mean, they're so far away. I would think it'd be more of an issue with Mexico. And I mean, I hate to say it, but it is still the fault of many people that do drugs, and don't do the drug.
Yeah.
Here in the United States, if you get offered fentanyl, don't take it. I mean, have a little bit of accountability, but it's flowing through. The scary part is, I guess, when it gets laced in, prescription drugs, and that's where it really gets scary in my viewpoint.
We are getting out of a little bit of our circle of competence here, but I do believe that sometimes people are, they hurt their knees or their back or something, and then they take drugs, and I think fentanyl's part of it, and they get hooked on it. I believe. I've seen movies on that.
Yeah.
So, yeah.
But the big thing we look at with these tariffs is it was 145%. That essentially created an embargo. I mean, you can't trade at 145% because you're better off definitely manufacturing here in the U.S. because it's just way too expensive. So, I mean, bringing it back down to 30% does make it more manageable. It's definitely 30% more expensive than it was for companies. But again, it is possible to still have trade at that level, or 145% not manageable whatsoever. I mean, I think you would have seen essentially an embargo, a complete pause in trade. So it'll be interesting to see over this 90-day pause how everything kind of works out. there is going to be that rhetoric back and forth, and I think you're still going to see volatility in the stock market because it might be like, oh, China said this, oh my gosh, they got to panic, got to sell because this deal is going to fall apart, and then maybe next week is like, oh, China's back at the table, oh, the stock market goes up. I think there's going to be plenty of volatility here surrounding this China drama.
We want to remind people it is for 90 days, which kind of worries me a little bit, but I think China, again, we talked about the weakness, but 90 days brings you up until about August, and then you get into September. You're now talking about the holiday season, because the holiday season, they don't manufacture products in November. They're manufactured in August and September. So I'm a little bit worried about that. Could that put a problem on our side? But we'll see how it plays out. So,
yeah, I mean, it'll definitely be interesting to follow.
Yep. Let's talk about inflation because it continues to cool. The headline consumer CPI for the month of April came in at a 12-month rate of only 2.3%. That was below the estimate of 2.4%. And what I love, this was the lowest reading since February of 2021. I mean, that was a phenomenal number. I was so happy to see that. I hope the Fed saw it.
Yeah, and I mean, we'll see what the PCE looks like later this month. My guess is that should be right around that 2% level. And again, they look more at the core, which core CPI was a little bit higher than the headline. Core, again, excludes food and energy, and that came in at 2.8%, which did match expectations and was in line with March's reading. So we didn't see that pullback I was hoping for. But again, at 2.8%, it's not that 2% level, but also, is it really that problematic? I don't think so.
And somebody said a long time to me, which makes sense. They go, I don't understand why they take out food and energy, because they're two important things. The reason why they do take them out because it's so volatile, which energy was a major help in the headline as it fell 3.7% compared to last year. With gasoline, that was down, and we've seen gas prices fall, except for here in California, fall by 11.8% over the past year. That's a huge decline. I mean, that really helps out your pocketbook.
We were doing some reading and did some posts on this, and I'm like, yeah, this is great. And I hadn't been to the gas station in a little bit, and by a little bit, I think it was like a week and a half or 2 weeks, and I went to go fill up, and I was like, I thought gasoline was down. So if you're watching this in Texas, give us a little sympathy here because it's no fun in terms of the gas prices. But back to the inflation report, one thing that is obvious is the tariffs weren't really part of this April CPI. And again, even though we are starting to get some negotiations working through, I mean, you still have a 10% baseline. Again, we talked about the 30% tariff. So there are economists that are worried about future months. And there's one gentleman, his name is Joseph Gagnon from the Peterson Institute for International Economics. And he said he believes a 10% average tariff rate would add as much as 1 percentage point to the CPI after about 6 to 9 months. And I think that when we look at this, I think you will see obviously CPI increase because you have an increase in prices. Well, somebody's going to pay for it. But we've talked about this a lot. It's not just the consumer that is going to absorb the full tariff.
Yeah, and that's the thing that we try to explain to people. It's not just a consumer. You've got the manufacturer. You've got the distributor. You've got the market. I mean, you've got so many hands involved in that. If they all take a little bit off the table, maybe the consumer gets hit with not a 10% increase, maybe a 1% increase. And actually, Walmart, they reported earnings, and I know that they said that they were raising prices on some items, and we talked about this as well, raising prices on some items that had no tariff effect, but because there was such high demand, they could raise the prices, and they didn't raise the prices on some companies or some products that had the tariffs on them.
Well, it's interesting. I don't know if you saw this. There's an ex-Walmart CEO, and he's like, well, if you actually look at their bottom line, essentially, their margin expanded.
Oh,
so he's
really?
like, they could absorb more of the tariff.
Yeah.
And that's the thing. And, when you look at this too, you talk about the manufacturer, you talk about the distributor, but I mean, you have to think again along the supply chain. And sometimes there's not just one manufacturer, like obviously with Apple, with their phone, well, they're using several manufacturers and then one company to essentially assemble the phone and then move it over. So there's several manufacturers essentially that can absorb part of that tariff. And then you even look at the transportation company, right? You ship it, let's say, across the world. And then you have the FedEx or the UPS or somebody there that is now going to transport here. There are so many different places that can absorb these tariffs, so it's not just a huge hit to the consumer. And the reason the companies will do this is because they still want to fight for market share. So I'm going to use your Walmart example, right? Well, if Walmart raises prices on something, Target might be like, hey, we could actually steal some market share back. We're not going to increase our prices there. that competition is what really generates such a robust and strong economy here in the U.S.
And you bring up a very good point about so many people in manufacturing, because we'll just say like an Apple or a computer. They got to get the chips, they've got to get the wires, they've got to get all these different things that are manufactured by other people to pull it in. So they say, hey, you're charging us, $500,000 for this. We need to reduce the price down to $450. Okay, we'll still make a profit. So there's so many manufacturers in there. And again, great point you brought up to transportation, because it's not just one shipping company. It's a shipping company. It could be a trucking company. Then the Federal Express does that. I mean, there's so many factors into that. And that's what I don't think people understand, how many people, if they just reduced a little bit, maybe they're not an increase.
And I want to be very clear. I still think consumer prices will go up on net a little bit. Yeah. This is not going to reduce consumer prices. There will still be an increase, but don't think it's going to be a dollar for dollar or percentage for percentage increase to the consumer. And I got to say, I saw consumer sentiment came out again, and I've railed so hard against this report. I just think it's ludicrous, frankly, that we even look at this. But consumer sentiment, I think, came out on Friday, and people are now looking for like a one-year inflation rate close to 7%. I do not think we're going to get to that.
Wait,
I mean, it's just crazy.
Who said 7%?
The consumer sentiment data. Consumers.
I heard that this morning, and I thought, well,
I didn't even write a post about it because I was like, this is just ridiculous.
Way out of whack, yeah.
And I know Scott Bessent, the Treasury Secretary, he almost said, it's like, I've learned a long time in this business. I don't even look at soft data anymore. It's all about the hard data. Because why are we listening to consumers that don't know anything about inflation? And I mean, that was just crazy to me that they thought it was going to be that high. And I think the 5-year inflation rate was something like 4.8%.
Yeah.
I mean, essentially double where we are now.
And again, there's many consumers that, again, that's why we do our show, and that's why we give you this information, that they talk emotionally. Like, inflation's up. It's going to go to 7%. Like, well, why? You have no data to back that up. And we again, explain very well why that won't happen. But it just sometimes they take that, I guess it's called soft data.
Soft data. Yeah, that's kind of the surveys and talking to people where the hard data is going to be, again, your CPI report. It's going to be your jobs report. It's going to be the retail sales. It's actual data that's coming in.
And I think some of that soft data is good on how people feel. But when it comes to asking them about inflation, no, they don't. I don't think.
Well, how good is it though when we talk about how do people feel, but then they still go to Padres games and spend a ton of money? It's not really a true indicator of people's actions at times.
Trying to be nice to the consumer. Let's move on to artificial intelligence because the big thing is people are so worried about it, and could it create more jobs as opposed to this? When I was thinking about this, it's like, I know back when the farmer was farming back around the 1900s and they brought in automation with tractors and all this. Oh my gosh, a lot of jobs went down, but the economy didn't fold because it created other jobs. And that's what's happening. They think it's going to reduce jobs for people. And that is just not the case.
Yeah, and it was interesting. We saw a use case here with the CEO from IBM. He admitted that AI, yes, it has replaced hundreds of workers. But then he also went on to say it has created more jobs than it eliminated. I was shocked by that. He then went on to say it frees up investment that the employer can put to other areas that include such jobs as software engineering. I was kind of surprised by that. I thought that might be something that might get hurt by AI, but again, I'm not a software engineer, so I'm not sure exactly what the details and intricacies of that job are, but that's one thing he pointed to. And this made sense to me as well, sales and marketing. If you're maybe spending less on one area, you can hire more salespeople, which ideally would be great so you can boost sales.
And customer service.
Mm-hmm.
Yeah. And I remember back, I believe it was on the internet. It's going to replace jobs. It's going to, lose jobs and so forth. And it didn't. I remember using an example on TV on my commentary that, at one point you would go into the elevator. You had an elevator operator that would hit the button for you. You would make a phone call. You had a operator connect the call for you. Those are completely gone. And the thing is, as humans, we hate to have change, but things are evolving and they're changing, and jobs that we don't even know about will probably be here in 5 to 10 years that they weren't even thought of. And it's the same thing. It just evolves.
Yeah, and I've brought this up on the show before, but it just blows my mind. So I like to bring it up. So if you haven't heard the show before, you know about this now. But I remember when I was getting married, this was, about 3 years ago now. And there's now something where, you have your photographer, you have your videographer, but then you have somebody there doing your social media day of so that people can see what's going on. And we didn't use that, so I don't think I used that for my social media or anything. But as a job that was not around pre-social media.
Yeah, and that's the thing. It's a thing that is actually out there. And normal things like creating spreadsheets and other routine tasks, they're going to be done by artificial intelligence. If that's what you're doing, your job is going to be replaced. But it still takes a human to do the critical thinking, to put all this together. And if you have to know how to use the information to enhance the business. And I did pull up some of the jobs that are going to be created that I didn't even know about, like an AI compliance manager. They got that. Virtual stores, SERPA. There was another one here, AI business development managers, AI content creators, AI product managers, man-machine teaming managers. So what's going to happen is that humans will be working more with the data. And if you're creating that data, like on spreadsheets or whatever, your job is going to be replaced. But you've got to know how to use that data. And we use AI in our business now. It's saved us so much time. It has really made us much more efficient. But you and I are still here.
Yeah, and I look at it, I don't think maybe replace, but maybe your job will be transformed. You know,
Yeah.
it's something that you got to be able and willing to bend your job as times are changing. Because, yeah, I mean, companies want to be more efficient. And efficiency maybe means you still have the same headcount, but if you can get more from that headcount, that's a big positive to the company.
Yeah.
So we tell people, I think, again, you got to understand the data, but also I think that intrapersonal skill is something that will be around for many years to come. There's still a lot of people that are like, I don't want to work with a machine. I want to talk to somebody.
Yeah.
So having good people skills and knowing how to use data, I think those are going to be the jobs that are going to be around at least longer than the other jobs.
Right. Well, unfortunately, we got to get to the next company, or to the first company. We didn't get to talk about oil, but that all is on our newsletter. Go to smartinvesting2000.com. Again, smartinvesting2000.com. Other topics there. Should you use a new money market ETFs? The Vatican, I was surprised in this, has a financial mess on their hands. Gig workers may be better entrepreneurs. The U.S. consumer still looks strong. And did Cisco finally reach its highs back in 2000? A good investment learning for investors there. So go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Free newsletter goes out every Friday at 5 o'clock by email, and that's 5 o'clock Pacific time. All right, let's move on to our companies here, because we want to talk about Dick's Sporting Goods, and I've always liked this company. We never bought it, but I always liked it. Their symbol is DKS from the specialty retail industry. I was shocked to see that the short on the float side is 11.3%. That's above what we feel comfortable with. We do see that the PE ratio does look good, 13.1 versus 19.6. Price to sales, 1.1 versus 0.6. Price to book value, 4.6 versus 3.3. And your price to cash flow is 11.6 versus 8.3. And again, valuation ratios, you always want them lower than the industry average. And they have a nice PEG ratio of 0.8, which means you're not paying much for the future growth of that company. Their earnings were up 16.3%. That's about 60% higher than the industry at 10.3%. Sales only climbed by 2.1%. Industry did beat them at 2.8%. The analysts seem to love it. Their 5-year earnings per share growth estimate is 14.6%. The industry a negative 1.3%. They pay a decent dividend. It's a 2.6%, using 30% of their earnings to pay that out. We do see that, let's see, on the balance sheet here, you got a current ratio. Good liquidity, 1.8 versus 1.7. The debt to equity, a little bit worse in here for me. It's 1.4 versus 1.3. That'd be the top of our range that we feel comfortable with. So they seem to have a lot of debt on the balance sheet. We also do see a net profit margin. That checks in at 8.7. That compares to the industry at 3.4. That's a big positive. And free cash flow. They did about 500. I believe that's 500 million. I don't think it's billion. Which was below the industry at 1.3 billion.
I'm going to give the numbers here on Dick's Sporting Goods, and then we'll kind of get into the conversation around them buying Foot Locker, which
what a surprise.
Yeah, huge surprise. But current price for Dick's Sporting Goods is $184.02. The 52-week range, the low here is $166.37, and the high $254.60. So it's really pulled back. The last week, which includes the announcement of the Foot Locker buy, it's down about 15%. Market did not like that announcement. And then year to date, the stock is down actually about 20% still. Going forward, though, I mean, the valuations on this company, they look good. I go out to January 2027. I see estimated earnings per share of $15.24. I mean, it gives you a target sell price at $252. $1.98, trades under 12 times those future earnings. But the big issue here is the announcement of the Foot Locker deal. I think it was terrible. I don't know what they were thinking. And especially with that high debt level you brought up, I think this is just silly.
Was it a cash deal or a debt deal?
This is what's interesting.
A stock deal.
It's very interesting. So they announced they're going to buy Foot Locker for about $2.4 billion. Their stock fell about 15% on the day. Foot Locker went up 85% on the news. So they were the clear winners there. But under the agreement for Foot Locker, shareholders there can receive either $24 in cash, which is a roughly 66% premium to the average share price over the last 60 days, or they can receive 0.1168 shares of Dick's stock. I don't know why you would take the stock option here. I think I would take the cash hands down if I owned Foot Locker stock. And the interesting thing, though, as I bring up with Foot Locker, is a huge premium on that day, right? As I said, it was up 85%, but the stock has been atrocious. Even with that deal, year to date, the stock for Foot Locker was up around 10%. Over the last 2 years, it's still down close to 40%, even with that 85% increase. 10 years, down 60%. Again, even with that 85% increase. I mean, the stock has been terrible. So I'm not sure what Dick's saw here, but I think this could be a big mistake, especially with that debt load.
And I think you said the offer was like $2.8 billion was the number?
2.4.
Okay, 2.4. Well, I just looked at the balance sheet real quick. Cash and equivalents, $1.7 billion. So that means...
Here's debt.
Yeah, if everybody... I don't see, again, why anybody would take the stock, I don't get it. But if everybody took the cash offer, they're going to have to raise their debt even more than what it is. And I want to say, gee, I like Dick's Sporting Goods, but I don't like that debt level, and that would be enough to tell me, like, no, I think I'm going to stay away from this company.
And the interesting thing here is the CEO came on because I was like, what are they going to do with it? And they're actually going to run the companies as two separate entities. Generally, when you do that, you're going to have accretion and you're going to run the companies the same, essentially. But the thing that I worry about is Foot Locker's international. It's also a totally different demographic than what Dick's Sporting Goods is used to. So now you're going to have to learn how to market to a different demographic. You're going to have to learn how to operate within a mall. You're going to have to learn how to operate internationally. I mean, it just didn't make sense to me. The only thing that is a positive here is they both have big kind of contracts essentially with Nike. Well, now Nike maybe is going to have to bend a little bit to Dick's since they're going to have a huge order book essentially. Right. That's the only thing I see as a positive. I think I would be a seller of Dick's at this level.
Yeah, I mean, so much more I'd like to say on it, but we can't. You got to go to a quick break. When we come back, we will be talking, finishing up with Charter Communications, Krispy Kreme donuts. Gosh, something strange there. And then also to Lyft, the car maker, and then our financial planner, Harrison Johnson, will be on as well. Stay with us. You're listening to Smart Investing Show with Brent and Chase. All righty. Welcome back to the second half of the Smart Investing Show. This is where we kick off with the financial planning topic with our CFP, Harrison Johnson. And Harrison, today you're talking about trust and retirement accounts do not mix. Well, we have these all the time. What do you mean they don't mix? They go together, don't they know?
They're both financial things, I guess. Tools. Yeah, there you go. But, you know, a lot of people have retirement accounts, IRAs, Roth IRAs, 401ks, whatever. All of those accounts have beneficiary designations, and you typically do not want to have your living trust be listed as a beneficiary of that retirement account. So people get trusts, and they think, well, I need to put everything in the trust. Your house, yes. Bank accounts, yes. Non-retirement accounts, yes. Retirement accounts, though, generally you do not want to have those listed as beneficiaries.
And this is one thing I'm sure you check for people, and every once in a while, and I've been doing this for 40 years, once in a while I would see that. Like, why? I mean, are you still seeing this? I mean, do people not get the message?
It happens sometimes, or the times where I see it where someone will go get a trust and then they'll say, okay, I'm ready to make my, I'm ready to update my retirement beneficiaries. And it's like, no, we don't want to do that. And I mean, there are cases where if you're working with an attorney to put a trust together where you can list a trust as a beneficiary, but it has to be for a specific reason. But in most cases, if you get a living trust, you want to keep that separate from your retirement account. It adds complexity, and the main thing is it typically causes your heirs to pay more taxes because it reduces their options as far as taking distributions from that account when they ultimately inherit it.
And I know Chase had a question, but I know we've seen this with big companies. Yeah. Is that
Yeah,
what,
well, that's
is that
what
what
I
you were
was
thinking?
gonna
Oh, okay. I'm sorry.
So
Take it away.
yeah, so I mean, we had a case relatively recently, and this is why we're talking about it. Not a client of ours, but there was somebody, they had an account at Fidelity and passed away, and we found, because we were talking with the heirs, that the living trust was listed as a beneficiary, and it causes a whole problem. In this specific case, it worked out because the living trust was deemed as what's called a see-through trust. It met some requirements where ultimately that money was able to be pushed into inherited IRAs for the heirs, and they were able to distribute over their 10-year that 10-year period. But if that's not the case, in many what happens is the money has to be distributed over a shorter 5-year period. So same account, same balance, same income, but now since it's over a shorter period, that just results in extra taxes. So we do see it, and ultimately, if you can list whatever beneficiary you want. Some companies might not bring it up; they might just allow you to do it, and your heirs are the ones that are going to have to deal with it.
I was going to say, it's interesting on that case is, Fidelity does some great things. I don't want to sit here and bag on Fidelity, but in this situation, the executor didn't really have a relationship with Fidelity. It was, again, the person that had passed away. They had that relationship. Well, they were kind of doing a lot at Fidelity on their own, and this person that didn't have a relationship with Fidelity is like, what do I do? And I'm like, oh, we can't talk to Fidelity. We're not on the account. I'm sorry. And I was like, if you can get me the beneficiary, we can kind of maybe help provide some guidance. And that's when we found out it was the trust. And I was like, well, normally you just split it to the different people. But in this case, I'm like, you're going to have to talk to them about the trust. And they're like, what does that mean? I'm like, oh, you're going to have to work with the estate planning attorney. You're going to have to work with Fidelity. It created so many complexities, as you said.
And that ended up to be okay because ultimately the beneficiaries were still able to, roll the money into their own inherited IRAs and be subject to the 10-year rule. And part of that is because the attorney that put the trust together kind of had a backup plan in case that happened. Yep. After talking to the attorney, they're like, oh, it shouldn't have been that way, but they're not the ones that actually list the beneficiary. So it turned out to be okay, but in many cases it doesn't. So again, if you have a retirement account, which a lot of people do, make sure that you're not putting that living trust as the beneficiary of it. It just adds complexities, and it's not something you would have to deal with. Right. It'll be your family members usually.
And I don't want to knock, Fidelity and Vanguard and principal of these big companies, but the problem is that there's no one really watching over. And if you don't know what you're doing and try to do it on your own, and maybe what if people say, well, I don't need a trust because I've got a beneficiary and I'm okay. What if you don't have all these things? No one is going to call you up from Vanguard or Fidelity saying, oh, you need to take care of this. Mm-hmm. That's why they need to have a good financial planner. And I'm a big advocate. We're not a small firm. We're not a large firm. We know our clients. They can call us up anytime. And the thing I'm always big about is getting the same person. They're not going to say, oh, I saw in Barron's this thing like, oh, the big teams now. Oh, well, if I'm not here, somebody else can answer it. I like to deal with one person. If somebody calls you up and say, I want to talk to Harrison, there he is. I want to talk to Chase, there he is. It's not like, well, you can't talk to me, you got to talk to Joe Smith because that's not my area. I mean, it's just, I'm not a big advocate of big companies. That's why we run our company very personally.
Yeah, and I mean, we have a lot of clients, but we know them all really well. And yeah. I mean, we're very accessible. So even if we're out of the office for whatever reason, you usually can get a hold of us if you need something. So
yeah. So I do have to admit, sometimes I can't remember the names. I recognize the faces, but not the names. Alrighty, well,
showing your age there.
Yeah, I know. Yeah, it is my age. Okay, I'll say it's my age. But no, that is good information. Again, look at this stuff, and this is why you need a good financial planner to look over things for you, find out things you don't know. What you don't know is a big problem. If you want to contact Harrison, give him a call at the office, 858-224-0004. Again, that's 858-224-0004, or go to the website smartinvesting2000.com. Again, that's smartinvesting2000.com. Send them an email, say, gee, I'd like to take advantage of that free consultation. And again, you'll talk directly to Harrison.
Yeah, no, it's definitely helpful. And again, this situation was just a mess. And, actually having somebody in your court. And I'll tell you, we have clients where they pass away, and we'd love to keep the beneficiaries as clients, but even if we don't, they're like, hey, I want to take the money to Vanguard. We're still able to help them with that distribution process, and there's somebody that they can contact that they know essentially they can trust, where this Fidelity situation, it's it's been a mess, and it's unfortunate.
Yeah, and I'm old school. I do believe in customer service and talking to people, and people, now that you and Harrison say, well, gee, what if something happens to you? Would you come up? What if you get hit by the bus? Well, I got Chase, I got Harrison. So, and I don't plan on getting hit by a bus anytime soon. So
look both ways before you cross the street.
That's right. All right, let's move on to our companies and talk about Charter Communications. And this is another one that I don't understand. It kind of blew me away what happened today or this week. But let's look at the numbers to see what's going on here. Charter Communications, symbol CHTR. They're in the industry of telecom services. Wow, 15.5% is a short. So a lot of people think this stock is going to go down. Institutional owned about 78%. Good PE ratio 11.9 versus 12.2. Price of sales 1.1, about the same as the industry at 1. Price to book value of 3.7 versus 1. I will point out there is no price to tangible book value for the company or the industry, and that means you take away all the intangible assets, well, no value to the company. Price to cash flow looks good, 4 versus 4.9, and the PEG ratio also looking very good. I don't get this for a cable company. PEG ratio only 0.6, which means you're not paying very much at all for the future growth of the company. Surprised here again, and we don't look at these numbers ahead of time. Their earnings per share growth over the last year was 16%. The industry, 48.6%. I thought cable was declining. Where are they getting this from? Maybe we'll find out that out when Chase talks. Sales are up 0.9%. Industry up 2.6%. Surprising number here from the analysts. 5-year earnings per share growth estimate for Charter, 18.5%. Where's that going to come from? I don't know. They do not pay a dividend. The balance sheet, a little bit risky here on the current ratio. It's a 0.4 versus 0.9, same as a quick ratio. That kind of worries me because if they start missing payments, they could be forced into bankruptcy. And the debt to equity, I'll look at the balance sheet while you're doing your thing, Chase. 5.9.
Whoa.
That is really, and there's no franchise here that I know of. I don't know anything special.
Financing? I don't think they finance equipment or finance cars or anything like that.
Yeah, so, something strange here. Oh, here's another bad thing. Intangible assets, 65%. So that means there's, again, well, we talked about no price to book value after you take those out. Net profit margin does look good, 9.4 versus 8.9. Return on equity also looking pretty good, 32. About double the industry at 15.7, and they do have free cash flow about 4.3 billion versus about 8.4 for the industry. So, what do you got going forward? What are you going to give me here?
Yeah, so current price here for Charter Communication, again, their ticker symbol is CHTR. It's $427.25. I got to say, I'm surprised by the performance of the stock.
Yeah.
The 52-week low is $266.06. 52-week high is $437.06. I mean, year to date, the stock is up about 25%. Over the last year, it's up over 54%. Over the last 5 years, it has struggled a little bit during that time period, down about 17%. But I mean, the 10-year return is really not that bad, 139% over that time period. So I thought this stock was going to be a terrible performer, but I'm going to say it's done okay. And going forward, I mean, the valuations still look quite good. December 2026 estimated earnings per share, $45.02. Gives you a target sell price of $747.33. Stock trades under 10 times those future earnings. I say there's excitement here over valuations, but I just can't justify this stock with the balance sheet.
I think there's because there's 19 analysts, others that agree with us because the range of estimates, the high is 51.93, the low 34.16. That always gives us a worrisome thing because wait a minute, why is it not closer than that? There's something else going on here. I think you had something else on it too, didn't you?
Well, I mean, the big thing, the reason we wanted to look at this was they were in the news this week. I mean, they announced a huge deal. They're actually going to merge with Cox Communications. That agreement values Cox, and Cox is a private company, at $34.5 billion.
You said merge or buy?
Merge. They say merge. I think it's essentially buy. But
okay.
The way it works out is $21.9 billion of that is equity and $12.6 billion of that is net debt. So the concern here is Cox has $12.6 billion of debt on their balance sheet. That's going to add even more debt to Charter's balance sheet, which could make it even weaker. And the other concern I have here is Charter's been kind of on a spending spree. They did announce it would acquire Liberty Broadband in an all-stock deal recently, and that merger with Cox is expected to close around that same time as the merger with Liberty Broadband. So, I mean, you're potentially going to be integrating all these different assets at once. I would imagine that would kind of be a little bit of a headache.
And we do spend, before you invest in a company, 10, 15, 20 hours looking at things because I'm not getting this at all. Looking at the balance sheet, you're not going to believe what their debt is. $93 billion.
Wow.
That's a lot of debt. And also deferred tax liability, another liability, is $19 billion. So you add the two together. I mean, they owe over, almost $110 billion. I mean, that's just crazy. And I don't know, are we missing something on this company that they do that is a growing business, that's growing the earnings? We did not look deeply at what the company does, but I just saw it's a cable company.
Well, I mean, obviously, internet. I mean, we use Spectrum. I mean, we use it business side. I used to use it personally, but I switched over to T-Mobile internet. Not a plug. I don't like T-Mobile stock. I'm not a T-Mobile salesman, but I've been very happy with the T-Mobile internet, and it's way cheaper. But anyways, you use it personally. We use it at the business. We use it for phone and internet here. I think you use the TV side of it as well at home. So, I mean, they have that. One thing, too, is I know my brother Nash, he's got a phone through Spectrum, and that is one thing, I guess, that they've really been pushing quite hard. I was kind of surprised by this. If I can find the number, I believe it was, here it is. Charter said it had 10.5 million mobile lines as of the first quarter after reporting another quarter of growth. So it seems like they're trying to push even harder into that business. Maybe that's where the growth is coming from. I'm not sure, but there's maybe that positive side, but you just can't, I think, justify it as I'm going to say conservative investor like us, because the risk is so high with that debt load.
And I think what I'm missing is that I'm stuck in years ago thinking this is strictly a cable company. You brought some good points up. Internet. You talked about also too.
It scares me with Starlink. I mean, Starlink's coming into the picture,
well,
and then I think Amazon, or not Amazon, but I think Jeff Bezos is trying to invest in it with Amazon, and there is formidable competition, and you have your traditional wireless carriers like I brought up T-Mobile. I mean, there's more people trying to get a piece of that pie. AT&T is another one trying to attack that internet space,
which is true. And then you also brought up that they do cell phones. 12 million people.
Over 10 million.
Over 10 million. So, I mean, they are going different areas. So, I guess you have to look at how much is the cable business declining, and they seem to be offsetting that. But they are buying Cox Communications, which, again, also has internet, but also has cable.
Yeah.
So, if you're going to look at buying these, keep in mind that high debt they have, you really got to understand this company, because it could be a great investment or it could be a terrible investment. And I think that's why the big range I talked about with the earnings, they're all board from 31 to 51, I think it was.
Yeah, and there's a couple other interesting things that I thought were strange, I'm going to say. So, with this deal, they're actually going to change the name to the company to Cox Communications.
Wait, so Charter's going to go to Cox Communications?
Yes.
Really?
Charter's going to go to Cox Communications within a year after the deal closes, but then Charter Spectrum will be the brand on its cable, broadband, mobile, and other services. So it's going to be Cox Communications from a business, but Charter's still going to be the consumer option, which I'm like, well, why don't you just change it to Cox if that's going to be the name of the company? It's a pretty recognizable name. But the other thing I wanted to point out that could be dangerous is Cox Enterprises will own roughly 23% of the combined company's fully diluted shares outstanding. If all of a sudden they don't like that direction, let's say 3-4 years from now, they start selling off stock, that could be a big problem, as that's a huge percent of the outstanding shares that would depress the stock price. I generally don't like when ownership is that concentrated, obviously.
I mean, we wouldn't be dealing with this company because of the high amount of debt that they have. But, and again, you bring up the good thing about the risk with the competition from Starlink and others. So the stock has done well, but I just still don't like it, and I would slap a sell on this.
Yeah, I would say if the balance sheet was cleaner, I'd be interested. But I'm not even going to waste my time looking at this company, because I was kind of intrigued until you said, 5.1 was the debt to equity, or 510%. No, not even worth looking at. That is way too risky in my mind.
Oh, and then I forgot to mention the cash, $796 million in cash.
There's got to be something on that balance sheet where there's got to be short-term investments or something else.
And remember, the current ratio is what, 0.4.
Yeah.
So they could have a liquidity problem. They're doing some great things, but they could have a liquidity problem where they have to file bankruptcy to restructure. So be careful of it. I mean, right now it's looking great, but yeah, I'm just not excited about it. So.
No, I'd agree. I'd agree with your sell rating there.
Okay. Let's move on to something I do get excited about. Well, not really. I mean, I do, but I don't eat them, but I love them. I'm talking about donuts.
Donuts are always good. I mean, they're a nice treat every once in a while.
Yeah, if I ate donuts, I'd probably be 250 pounds. So I avoid them. But boy, when they're around, like, oh, I'm going to grab one. Let's look at Krispy Kreme donuts. That's what we're talking about. Their symbol, that's why I say it, is DNUT. Do not. Donut. So in the grocery stores, I guess they're considered a grocery store business. Wow. Here's something amazing. The short on the float side is 25.4%. This stock is sitting on a lot of short shares. Only 54% institutional owned, means a lot of individuals bought this stock. No PE ratio because of no earnings. Price of sales, 0.3. That is still higher than the industry at 0.2. Price to book value, 0.5 versus 2.9, but there is no price to tangible book value. Again, intangibles would wipe out any value here. Price to cash flow, 12.8 versus well over 500 for the industry. No PEG ratio. We do see earnings of last year, no earnings of last year. Sales over last year are down 6.5%. The industry was actually up 1.3. I wonder who these analysts are. That's one thing we can't find because a 5-year earnings per share growth rate for the analysts, 26%. I mean, are they not seeing what's going on? And maybe people love Krispy Kreme donuts.
Or it's coming from such a low base. I mean, you go from negative earnings even to slightly positive, you could have good growth.
Could be a math anomaly, I guess. Yeah. So they do pay a 4.4% dividend, which I think that's not going to last much longer. No payout ratio because they have no earnings. We do see that on the balance sheet. Let's see if they got a good balance sheet. Here's another one. Current ratio, 0.4 versus 1. And we don't like a current ratio much below 1. That means you can actually pay your next 12 months of liabilities or 12 months of assets. 0.4 means you can pay maybe your next, 3 to 4 months. That's not a good position to be in. And their debt to equity is also kind of high, 1.3 versus 1.6. Net profit margin, negative 1.4%. They lose about 1.5% for every donut that they sell. Return on equity negative 2. Free cash flows a negative $75 million. I'm going to say maybe eat the donuts if you like them, but don't eat the stock.
Yeah, I mean,
unless you got something different.
It's not looking good for Krispy Kreme, unfortunately. Their current price, $3.17. 52-week range, the low here's $2.58. The high, $12.68. Year to date, I mean, the stock has just been hammered down 68%. And it looks like the stock came public again. I believe they were public years ago. They went private or went bankrupt. I'm not sure what happened, but they definitely disappeared off the stock exchange. Reemerged in 2021. The chart I'm looking at was around like $21 a share. It looks like kind of its peak, but since then it's just down, obviously, to go from 21 to 317 is definitely a problem. But going forward, I go out here to, it looks like they do report on a calendar year, so December 2026, just 2 cents in terms of the estimated earnings per share gives you a target sale of 33 cents. I mean, this company's having issues, and the big problem that came about, it caused the stock to fall about 25% last week, was they were actually reassessing the rollout they had with McDonald's, where they were going to be in all McDonald's locations. Looks like that wasn't really a profitable endeavor for them. Actually, management did say that they're slowing down that rollout for profit reasons. They had to really kind of ramp up that supply. And when they were doing so, they expanded capacity quickly, which then weighed in profits, caused 3 quarters of net losses. So that's maybe why earnings are expected to increase, not positively, but because they got so bad that they're trying to get back to a more normalized rate. And it looks like this McDonald's rollout was maybe too fast for them, and they should have taken a more measured approach. And now they're pulling that back, which will hurt sales growth, but maybe in the sake of saving profits. They also did pull guidance as well, which generally investors don't like to see. So I'm not liking it.
I'm pretty sure, your memory is better than mine. But I think when this happened, this deal with McDonald's, I think we talked about it and said, wait a minute, how are you going to share the profits with McDonald's? I think McDonald's probably took too much of the pie.
Sure.
And therefore, Krispy Kreme's had no profits there, and it was expensive for them. And we talked about that before. This deal just doesn't make sense to us. And sure enough, if you said, no, you're wrong, you bought the stock, you're not doing well.
No, it's definitely been hammered quite hard.
And that's why we look at things so closely to understand. And don't just get excited about what's going on. Look at the numbers. So you want to talk about Lyft?
Well, let's talk about Lyft. Maybe we'll need a Lyft here because we've got 3 sales so far.
Okay. Lyft is the car, what do they call it? What do they call it? Ride sharing.
Ride sharing.
Thank you. Symbol LYFT, software application industry. I guess that's where they fit. Short on the float, 10.8%, 85% institutional owned. Not a great start, which doesn't surprise me. PE ratio 112 versus 128 for the industry. Price of sales looks good though, 1.2 versus 7.4. Price to book value 8.4 versus 7.7. Price to cash flow looks good, 7.2 versus 34.6. No PEG ratio. No earnings for the past year for Lyft. The industry was up 12.3%. Oh, sales for Lyft climbed by 27.3%. That's a huge bump in their sales. Analysts, another strange number here, five-year earnings per share growth estimate for the analysts, a negative 165%. So they're not looking for any growth. They're looking for a decline in earnings, which I don't get. We'll talk more about why, because I think this is a growing industry. On the balance sheet, we'll take a quick look there. Current ratio 0.8 versus 1.9. I'm kind of okay with that. Debt equity 1.4 versus 0.7. Kind of okay with that if they got some other things going on. It depends on the cash flow. Net profit margin is 1%, so they're profitable at the absolute bottom line, but the industry's at 10.8%. Return on equity 6.8 versus 15.9. Cash flow $920 million. I mean, it's not as bad as it used to look. I don't know what you're going to give me going forward, but I'm kind of opening to listening because maybe some positives here.
Yeah, I mean, it looks interesting. And I say that because the current price is $16.77. And here's another, I'm going to call it a tech darling that really has faltered. I mean, it kind of looks like it came public in 2019 around $78 a share.
Let's buy those IPOs.
Yeah. And it then fell during COVID, obviously. Then it rebounded back into the high 60s. And again, now it's back around $16.77 is that current price. 52-week range, though, $8.93 is a low. So it really fell down there quite low. And the high here, $19.07. We go forward for this company out to December 2026. I see estimated earnings per share of $1.38. Gives us a target sell price here of $22.91. That is a forward PE of under 12 times. I mean, it's a good value, and you're getting earnings growth this year of 19%. Earnings growth, or I should say, you're getting estimated earnings growth this year of 19%, and estimated earning growth next year of 22%. So it's growing earnings. You're getting a decent value here. I think it's intriguing.
I got a question mark on my face because I think you said the earnings you're getting from Seek Alpha is
$1.38.
38. Now I look at Stock Rover going out to 2026, 43 cents.
Interesting.
Yep, and they have 32 analysts. One says 0 for the earnings going forward. 79 cents is the high, and 32 analysts. So
I got 15 analysts.
So maybe you don't have the ones that don't like it as much.
Yeah, so I mean that's why we do use two software programs to kind of provide a nice check and balance. So that would throw a wrench in the plans over my excitement over Lyft. I will say from an economic standpoint, though, there was some good news out of the stock, and they reported last week, and the stock surged 24% or something crazy. It was a huge increase in the stock price. But the thing that I thought was interesting, and this was from the CEO, again, talking earlier in the show about hard data versus soft data, we look at the CEO from Lyft. He said he doesn't see anything to worry about despite widespread concerns of a slowing consumer amid ongoing economic uncertainty. He said, our team is stronger than it's ever been, and the consumer demand is absolutely there. And that was based off gross bookings growing 13% from a year ago. And the number of rides, I don't understand the difference between gross bookings and rides. You don't own the company, so interested in the difference there. But rides grew by 16% compared to last year. So they're seeing growth. And again, if you're not having a growing economy, and it's slowing, in fact, you're not going to be seeing more rideshare activity, especially ridesharing's been around for so many years now. It's not like it's a new hot thing. That to me is a positive for the economic growth.
And I do see that industry growing. I'm disappointed that I can't say buy it because of the 43 cents. But I think it's something that is a growing industry. Maybe it's just too early yet, but I do see the day that they'll have the robo-taxis. That's not going to prevent it from coming. That is on the way here. And I've heard, I think Elon Musk or somebody said it's going to be here in a year or two.
Yeah, and he's been saying that for 5 years though, 6 years. So
one of these times he'll be right.
One of these times he'll be right. I will say they did announce a $750 million stock buyback, and it's all relative at the end of the day. That sounds small when you compare it to Apple, but their market cap here is about $6.8 billion. I mean, that is over
10%.
10-12% of that outstanding shares. I mean, that is a sizable buyback. But the big thing I want to look at with this stock in particular, you talk about the autonomous. What is their plan here? I mean, because you have Waymo. Is Waymo going at it alone? is Tesla, are they going to utilize a Lyft, or are they saying, no, we're going to partner with Lyft, or are they going to do it themselves? I mean, if they do it themselves, Lyft could totally get kicked out of the equation there.
I don't think they can do it themselves, because I think the big thing that Lyft and actually Uber have as well is the data that they have that they can use to do the robo-taxis. So, unfortunately, gosh, closing bell comes too quick. Thank you for listening to the Smart Investing Show. It is for informational purposes only and should not be used as investment advice. Let's discuss in more detail your investment needs, have other investment questions. Feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-224-0004. Again, that's 858-224-0004. Or visit the website smartinvesting2000.com. Again, that's smartinvesting2000.com. A lot of great information there. Sign up for the newsletter there. You can listen to the podcast there and many things. Again, smartinvesting2000.com.